when you are shopping hard money, be sure you're comparing an apple to an apple. It's Kevin Amos, Pine Financial Group. We work together so you succeed. Hey, you found us here on Facebook, you found us here on YouTube. Please help us out. We're trying to build a community to help more real estate investors just like you. You could do that by hitting like, hitting subscribe, and leaving us some comments below. Hey, in this video today, I want to talk about mistakes I see fix and flippers make when they're borrowing hard money. Now, as a hard money lender, we obviously talk to a lot of real estate investors and real estate developers that borrow hard money. Now, this is a competitive space at times. So if you're out there doing these deals and you're calling around, talking to different hard money lenders, here are some of the things to keep in mind so that you can maximize your profit in your fix and flips and minimize your risks. Because there is risk when you're borrowing from hard money lenders. They're fantastic. It's a tool in the tool belt. For a lot of fix and flippers, it's used regularly. Maybe it's like a hammer for a carpenter, right? It's one of those tools that just come out on a pretty regular basis. So it is good to understand these and understand what mistakes are being made and how you can avoid them. So number one, understanding the costs. See, at Pine Financial, we have no hidden fees. We do have an administration fee, but it's the lowest in the industry. I don't know another hard money lender that charges a lower admin fee that we do, but every hard money lender charges some sort of administration fee. So if you get a quote for a pricing quote and they say, hey, 2 points, 12% interest, something like that, well, the 2 points is the origination fee, and there's going to be additional fees to that. You typically have an origination fee and some admin fees, underwriting, credit report fees, processing fees, that sort of thing. I just kind of lump all that into an administration fee, but it could be called anything. Right, so almost every lender, maybe every hard money lender that I know, does charge some type of processing fee to help cover some of their overhead and that sort of thing. It's also additional profit, but be aware of that. So if you're comparing a 2-point loan to a 2-point loan, what other fees are you seeing? Some other fees that you might not see so easily are exit fees, for example. So you might have a origination fee to get into the loan, but is there going to be a fee when you get out? Sometimes we see release recording fees, and sometimes we see legit exit fees. Like you might have to pay another point to get out of the loan when you pay it off. So these are not always as easy to see, but it's definitely going to affect your bottom line. So you need to account for that when you're running your numbers on your fix and flip or when you're comparing a hard money lender to another hard money lender. So exit fees is one of the more common hidden fees that we see. I also see a lot of minimum interest charges. So let's say you can get in and out of a property rather quickly. Some lenders might do a 4, 5, or 6 month minimum interest charge. So no matter how long you have the loan, even if you pay it off early, you're going to owe at least 4 months of interest. So sort of a tricky little hidden fee if you're going through the projects quickly. If you're very efficient and good at fixing and flipping, you might end up getting caught with this sort of thing. So they call it a minimum interest earned, and a lot of hard money lenders are starting to do that. We are not one of them, but a lot of them are, so be sure you ask and understand about the minimum interest. Another common one I see is the draw fees or inspection fees. Now, this isn't a hidden fee. Every lender that's going to come out and inspect your property and issue you draws for your construction, they need to charge some kind of fee because the inspectors are charging them, maybe the title company is charging them, that sort of thing. So you will see some sort of fee, but if it's $100, $200, something like that, that's probably covering costs. Anything above that, that's an additional profit to the hard money lender. So if I see sometimes a $400, $500, $600 draw fee. Well, it doesn't cost $600 to process a draw. So there's an extra little bump in profit for the lender there. So again, when you're comparing a lender to a lender, look at the draw fees, and so you could at least try to compare an apple to an apple, let's say. Okay, understanding the draw process is mistake number 2. There's a lot of nuances here. So if you're fixing and flipping and you need money to get to your contractors to get that repair done and get that property sold, understanding that draw process is vital. So the first thing and the biggest risk I see for real estate investors is the money going to be available when you request a draw? Do they have the money set aside for you when you're ready for it? Not all hard money lenders physically take that money and set it into a separate account. Okay, if they're not moving that money into a separate trust account, then it could create a big problem and potentially double charge you interest, right? Because they're charging you interest on money they have loaned out to somebody else. And then when you need the funding, it's not in their bank account, right? It's loaned out to somebody else. So you can't even get to it, even though it's your money under your loan documents. They're obligated to lend that to you based on the note. And sometimes they may or may not have that money. I know it sounds crazy. I know it does. But I see this common. In fact, we get a lot of business from other hard money lenders, not referred by the hard money lenders, other borrowers leaving other hard money lenders because they can't get their draws processed quickly. So that's number one. Where is the money? How does that flow? And maybe you document it. Can I see that you have the money set aside for me? Something else is just a process in itself. Like, how does the inspections go? Like, some of ours, for example, will say, okay, we use a third-party inspection company, but they don't physically come out because this is a good loan. We feel good about it. We don't need to physically be there. But it does GPS stamp when you take your photos. So if you take your photos in the app, it tells us that you're at the property and we can see that the work is done. And that speeds up the process quickly because it's just you go out to your own property that you're out every single day probably, snap some pictures and you get the process started. Otherwise, you might be waiting for inspectors and scheduling, and all of that is not uncommon, so I'm not trying to be hard on that. It is common, but it will slow you down a little bit. So what's the process to get the draw? How long is it going to take? What are my expectations here of my lender? And are they following through with those expectations? So understanding the process. And then again, like we touched on, what are the fees? What's it going to cost me to get through these processes? And then finally, I alluded to this, but I want to make sure that we talk about it. Are you getting charged interest on that money? And if you are, make sure that money is set aside for you and it's ready for you to pull it. We do both. Sometimes we won't charge interest on it. And in that case, we do not move the money over. We'll draw down from our accounts or a bank line or something like that when you're ready for it. But it's not physically moved over for you. Otherwise, we have to charge interest because we lose access to it, right? And if we're not charging interest on it, then there might be some delays getting that money out to you because it's not already readily available. So just understand those sort of things when you're shopping your hard money lender and going through the inspection draw process. Okay, number 3, the third biggest mistake I see real estate investors make when borrowing hard money is over leveraging. Look, every hard money lender I know understands real estate fixing flipping. Okay, they understand real estate investing. That's why they are where they are. Being on the lending side of the business is actually a pretty fantastic place to be. Sure, we don't make as much money as you do fixing and flipping the property, but it's pretty easy. It's a pretty secure position. It's a nice place to be. So a lot of sophisticated investors, they may go through fixing and flipping as a career for a while, build up some capital, and then they become on the lending side just because it's a little easier. So it's not uncommon to see very sophisticated real estate investor hard money lenders. And I'm only saying that because there's a reason they loan 65% or 70% of the value. That's where they're safe and that's where you're safe. What I see the mistake made is, okay, well, I'm only getting 70% from Pine Financial or insert hard money lender. So I'm going to go out and get the rest of the money over here from another investor, and they're going to gap fund, they call it. They're going to come in a junior position or maybe equity and cover any gap from my private money loan. Well, now you're over leveraging, and as soon as you go over the threshold of the hard money lender, I believe you're taking on too much risk. Now, if you put your own capital into it, you're not taking the additional leverage risk, right? So you're still in a safe position to get out and get everyone paid off. Even if you take a small loss, you're in a loan to value position to get everybody taken care of, not hurt anybody and not have any lawsuits. So gap funding is a big issue. Bringing on partners is a big issue. And then one other one that I've been seeing more recently is, I'm going to go ahead and call it appraisal fraud, but trying to manipulate an appraiser to come up with a higher value. We just saw one today, actually. An appraisal came in and was so ridiculously high. And when you actually read through the report, which many people don't read appraisals, right? They just look for that value and they call it a day. Well, if you read this report, it was subject to some phantom lease that didn't exist yet. It was a promise from somebody to lease the property at a set price, which is high, much higher than market value. And assuming that lease came through, then the value would be true. Well, that's probably never going to happen, so that value is never going to happen, right? But a lot of lenders won't, not necessarily lenders, but a lot of investors, or maybe some lenders, frankly, won't look at why that appraisal is so high. and now you're using a high appraisal that you're never going to sell it for to get a loan higher than you probably should, and now you're in some trouble. So inflating appraisals is starting to become a bigger issue, and I'm starting to see aggressive real estate investors do that. Oh, and by the way, if you over leverage, you're paying more fees and interest than you should otherwise. So maybe that's an obvious one, but obviously, let's keep the leverage low. That's why hard money lenders are at 70%. So those are my 3 biggest mistakes when borrowing hard money. Again, as a quick recap, not understanding all the costs. There's lots of hidden costs in this business and sometimes some shady transactions. So just be careful with that. Understanding the draw process, that could really get you, and I've seen it get other investors. And then don't over leverage. There's a hard money lender loan to value ratio for a reason. So try to stick with that. And then the last little piece of advice, it's not a mistake necessarily, but when you are shopping hard money, be sure you're comparing an apple to an apple. A 0% origination fee, no points, and 14 or 15% interest is basically the same loan as a 1% origination or 2% origination and a 10, 11, or 12% interest, right? However the math works. It might be the exact same loan for the amount of time you're in the deal. It could be riskier if you're in the higher rate with no points, because if it delays, if your contractor's behind, if it takes a little while on the market, it's probably even more expensive for the 14% rate. But I see a lot of investors attracted to that loan because there's no points. So they think it's a cheaper loan. Vice versa, I see people chasing rates. So maybe they'll pay 2 points in origination, but they want an 8% interest rate, which is pretty much bank money at this point. And then they'll pass on another hard money lender that's 1 or 2 points and 12% interest. And it's all because of that interest rate. But what they don't understand is, well, that 8% interest rate is almost bank money, because it basically is. It's a fully qualifying loan. You have to have lots of money to put down. You got to have a lot of money for the construction contingencies, a lot of hoops to go through. And maybe their draw process isn't as good because it's a much larger company and their money is coming from institutional investors that have a lot of rules. So that's not an apple-to-apple comparison compared to a true hard money lender where it's private capital, where they own and service their own loans. So either one can be good. Different tools in the tool belt again, but both of them can be very beneficial to your investing. So understand the differences in the hard money and make sure you're comparing an apple to an apple, I think is the best way to go. And make sure you understand what your goals are with the hard money lending. Is it more important that you close on time and that you get those draws quickly? Or is it more important that you hit the lowest interest rate? Because those are, again, different. Hopefully this video helps you. If you have any questions about hard money, that's what we do. We're experts in that. We'd love to help you. Even if we don't do business together, we still want to see you successful. We are successful when our clients and our followers are successful, so that's what we're trying to do here. Get more information at pinefinancialgroup.com. Again, check us out, pinefinancialgroup.com.